Welcome to Final Expense Telesales. My name is Dana Neeson, and welcome to my brand new 5-part series, the 101 for New Life Insurance Agents. Now, I know I have a ton of content on this page for really mastering a sales process, understanding how to take a prospect from being closed to being emotionally open to wanting to make a change. We talk about best practices for success for telesales. But today I am focused on you, a brand new agent who is thinking about getting licensed, who just passed and got their license and is figuring out what to do with it and where to go, or even agents who have been in the business for under a year who are still kind of floundering out there trying to figure everything out. This series is going to help you give the foundation for what you need before you even think about buying leads and trying to memorize a script. So today we're going to be focusing on part 1, which is final expense life insurance terminology. All of these series are going to come with a downloadable guide, quick reference guide for you to have. To download this guide for yourself, all you need to do is go to the description in this video, click the link, and you can download this form for yourself. Over the next 5 days, we're going to cover things in addition to just terminology. We're going to talk about, tomorrow, we're going to talk about common health conditions and the associated medications that come with that, so you can be more of an expert when you're talking to people about their health and you go into underwriting. We're going to talk about the difference between pre-need plans, prepaid plans, and life insurance. We're also going to break down veterans benefits. You will talk to a lot of veterans who think they have everything covered, so it's important that you understand what they get and what they don't get. We're also going to break down what it costs to actually have a funeral or cremation. All of these things will help set the foundation and make you more confident in this new industry that you've chosen. So without further ado, let's start with the most common terms that you're going to come across when you start selling life insurance. So we're just going to go down this list one at a time. And the first one we're going to talk about is preferred. Now you'll see this when you're generating quotes, especially if you're using something like insurance toolkits. And preferred is a rating that are associated with the lowest risk prospects, meaning they really don't have any health conditions and maybe a little bit of high blood pressure that's managed with medication. They typically pay the absolute lowest premiums with all the carriers, and of course they have no waiting period. So anytime you see the word preferred, that's a really good thing, and you should definitely encourage these people to jump on it because, you know, our health can change at any moment. Now, the second term you're going to see here is level. Now, level really doesn't describe the type of policy in regards to its rating. What level means is that the payments never go up. The coverage never goes down. It's basically another term to describe a whole life policy. You wouldn't have a term policy usually that has level payments. Typically with term insurance, those payments keep going up every few years or so, or that coverage can go down. So if you have a level policy, it means the death benefit and the premium payments remain the same throughout the policy term. All right, let's move on to standard. Standard is a second classification right under preferred policies. Now, these people have mild to moderate health conditions, but they still qualify for same-day coverage carriers, but the rates might be slightly higher than preferred. There's lots of carriers out there that you can get standard coverage with, even with conditions like COPD or managed diabetes with medications. There's other carriers that will make them graded, which we'll talk about here in a second. So standard is good, still no waiting period. Rates are slightly higher than preferred. The next term that we have here on this list is immediate. You'll see immediate, meaning that immediate policies have no waiting period and the coverage begins the first day the premium payment is made. Next thing on our list is graded. Now I'm going to read this to you. Instead of paying the full death benefit immediately, the insurance company will pay a portion of the death benefit if the insured dies within a certain period. Typically, and this is an example, if your client has a $10,000 death benefit and they have a graded policy, Now, here's a big disclaimer here. Not every insurance company carries the same definition for all of these terms. This is mostly universal, but please refer to your specific carrier's definitions moving forward. In general, graded means a percentage is paid in the first 2 years. So if your client has a $10,000 policy and they pass away in the first 2 years, the first year, the family might get 30% of the death benefit, which in this example would be $3,000. If they passed away in the second year, the family would get 70% of the death benefit, which would be $7,000. And after that 2 years, the full 100% death benefit would be eligible to be paid, which would be the $10,000. Now, graded is different than the next term we have here, which is modified. Okay. Now, again, some carriers have slightly different definitions for these terms as well, but in general, this is how most people agree that the definition should be. Modified is used to describe a policy that returns premium payments if the policyholder passes away in the first 2 years plus interest. So the difference is with graded, the family gets a chunk of that death benefit. With modified, if the client is paying $100 a month for their $10,000 policy and they pass away in the first 2 years, the family would typically get all the $100 payments that client made plus 10% interest. So if I get my calculator out here and the client passed away after 1 year, let's say they made 12 payments, the family would be owed $12,000 plus an extra $120 for that interest. Now, it doesn't sound like a lot of money, but if the family did nothing at all and just left that money in the bank account, there is no bank in America that's going to give you 10% interest on your money. So if this is the only option for your client, it's still better than nothing at all. And they don't lose anything, right? All the money gets paid back. So it's just a matter of how you position it and making sure they understand. All right, leading us right into the next one here, which is GI or guaranteed issue. Now, GI pays the same as modified, the one that we just described. The difference with GI policies is that this type of life insurance policy does not require any health questions, where the modified policy will still ask some health questions and will still have reasons why the client could not get approved. You can still get declined. But with guaranteed issue, it's named that way because you can't get declined. You could be on your deathbed and you could still get guaranteed issue policy, although it's a pretty big risk to you, the agent, because you're just setting yourself up for a chargeback in the first year. So guaranteed issue, this is a last resort for clients who cannot get approved for standard, modified, or even ROP, which we'll talk about in a minute. There is still a 2-year waiting period and premiums are typically higher. Guaranteed issue policies typically have the lowest persistency, which is the percentage of policies that stay active in the first year. Actually, looking at this now, I probably should have added persistency as a key term that you need to understand what that is. So when life insurance policies look at you, the agent, as low risk or high risk as far as writing business and sending business to them, they're going to look at 2 things. They're going to look at a placement rate and they're going to look at your persistency. So you might want to write this down since it is not here on this sheet. Your persistency means if Dana submits 20 policies in her first year or in 1 year, what percentage of those 20 policies stayed on the book after 12 months? Ideally, you want to be over 80%. And if you're selling the right way, and if you have a good group of carriers that you're aligned with, it could be even higher than that. Because if you're doing the right thing by the client and you're not just pushing something onto somebody, then you should be able to keep that business on the books unless, again, the client is just, so unhealthy that they pass away in the first year or they don't manage their money well, and you're going to find that everywhere in final expense. Okay, so that was the persistency. Now the placement rate, which also isn't on here, which I may go back and add these terms to this sheet. The placement rate means of the 20 applications that Dana submitted for approval, what percentage of those actually made their first payment and placed? And that's really important too. We want to make sure that we're writing business that sticks in the beginning as well as the end. All right, let's move on to 10 pay or 20 pay. These are types of permanent policies that just have a slightly different payment structure. You typically can't even get approved for a 10 pay or a 20 pay unless your health is either at the preferred or the standard level. So you have to be pretty healthy to get this. With this coverage, the prospect pays premiums for 10 years or 20 years only, and then there's no more payments for the rest of their life. But the protection remains in force forever. 10 pays are more common with like children's whole life, but you can definitely find 20 pay policies for adults. And those are really great, especially for the people that want to say, well, if I just save this money myself, you know, if I live another 40 years, then I'm going to pay way more than what the policy's worth. So make sure that you have at least one carrier that you can write a 20 pay policy for healthy individuals. ROP. Okay, so there's a couple definitions that I think are floating out there for ROP, which stands for return of premium. I've seen ROP used in the same way that modified and GI policies are thrown out there, where the person just gets their return of premium payments if they pass away in the first 2 years. But it's also commonly used in a type of term insurance where the insured outlives the policy term and then all the premiums are refunded, but with no interest. So it's a very low risk type of policy to get, where if you got a 20-year term and you outlived it, well, then the insurance carrier just refunds you all of your payments. And the price for those are much higher, because if you do outlive it, which if you are getting approved for term, the chances of you outliving it are probably high, then the carrier just has to pay everything back. So I wouldn't necessarily recommend that unless you have to. Again, if you have someone that's on the fence about whether or not they should save or get a policy, that could be an option for you to look at. And finally, the last term we're going to cover here is the contestability period. And this is an important term that I'm surprised how many insurance agents have never heard this before. So the contestability period is a time frame, which is about 2 years from the time the policy goes into effect, during which the insurance company can investigate the application and potentially deny a claim if they find that the applicant or the life insurance agent, because this happens too, lied on the application. So even if you get a customer approved for preferred or standard or immediate, right? And that client passes away in the first 2 years, that doesn't guarantee that that payment is going to be paid out to the family right away. That actually throws up red flags. Why would a seemingly very healthy person pass away in the first 2 years of getting this policy? So what that does is it protects the life insurance carrier from fraud. And also, make sure that someone isn't writing a policy on someone that has maybe something planned, to get rid of somebody else. I mean, there's so many different ways. It also prevents them from suicide. That's why contestability period is there. So if someone doesn't get a $50,000 policy on themselves and then kills themselves a week later. So all of that to say that the contestability period is important. It is for every single policy that's written. And make sure that you know that. It's also important to understand that if you get somebody on the phone that has had a whole life insurance policy for more than 2 years, it may not be in their best interest to replace it. Because what have they already gone through? They've already gone through the 2-year contestability period. And replacing it with another policy just so that you get commission, even if the pricing is just a couple dollars difference, they need to understand what the risks are, and it may not be in their best interest to switch that over. I would probably consider adding instead of replacing in that case. All right, so that is part 1 of our New Agent 101 series. If you'd like to download this form behind me, go ahead and submit that link below to fill out your information, and that will be sent to you. Tomorrow, We're going to dive into common health conditions and the medications that are associated with it. This one is super, super important. You do not want to miss it. If you are interested in getting this level of education as a life insurance agent selling at a high level, we are also accepting interviews here at Empowered Life Group. You can visit my website at empoweredlifegroup.com, watch the quick video, and fill out a form to schedule an interview with me. And I'll see you on part 2 tomorrow. Thanks and have a great sales day.